Today, I want to begin with something that, in my view, completely changes the way you should understand what is happening in the gold market right now. Most people are only looking at the price. They are only looking at the chart. They are only watching whether gold went up or down, and then they reach a very simple conclusion. If gold is falling, maybe the story is over. If gold is under pressure, maybe it no longer has the strength it used to have. If gold is not moving straight up despite war, uncertainty, and global tension, then maybe the world has changed. But I believe this is exactly where most people make their biggest mistake, because the real question is not why gold is falling. The real question is who is selling it, why they are selling it, how long they can keep selling it, and what happens after that selling stops. Today, on April 14th, 2026, gold is trading near $4,770 per ounce. A few days ago, the market was under heavier pressure, the dollar was stronger, oil was moving higher, and gold was pushed lower. Then today, a softer dollar, some relief in oil, and hopes of diplomacy gave it support. That means one thing is already clear. This market is still extremely sensitive, and every move in it is not being driven by a simple fear or safe haven story alone. And this is where I want to give you a different framework. I believe there are not one, but two completely different forces operating inside the gold market right now. The first force is the one everyone understands. When there is war, global tension, weak currencies, bond market anxiety, or fear of inflation, people look toward gold. That is an old, tested, and repeatedly proven truth in financial history. People like gold because it cannot be printed. It does not sit under the direct control of any central bank. It cannot be created with a digital keystroke. And when the world becomes truly uncertain, gold stops being just a metal. It becomes a substitute for trust. But the second force is the one very few people understand. And in my view, that is where the real story is right now. That force is forced selling. Yes, forced selling. This is not the kind of selling a wealthy investor calmly plans in advance. This is not the kind of selling that comes from a long-term portfolio strategy. This is not the kind of selling based on the idea that we have decided gold is no longer important. No. This is the kind of selling that happens when your choices begin to disappear, when you need dollars immediately, when your currency is under pressure, when oil becomes more expensive, when war starts reaching into your own financial system, when you are forced to sell the one asset that can be turned into cash quickly. And that is exactly the point where the gold market can no longer be understood by looking at charts alone. You have to understand the global energy story. You have to understand the dollar story. You have to understand the pressure on central banks. You have to understand that sometimes gold does not fall because it has become irrelevant. It falls because it is the only thing left that can be sold to give the system temporary breathing room. That difference is not small. That difference changes the entire investment perspective. Take Turkey as an example. At the end of March, Turkey's central bank reported the largest weekly drop in its gold reserves in 7 years. Now, do not just treat that as another data point and move on. There is a much bigger picture behind it. When a country imports energy, when its domestic currency is weakening, when oil prices are rising, and when confidence in its financial system is being tested, then what does its central bank have left? It can either let the currency fall and allow inflation to accelerate further, or it can keep burning through dollar reserves, or it can sell the asset that can most easily be converted into dollars. And that is the point where gold stops being just a strategic reserve and becomes emergency liquidity. This is the part I want you to understand deeply, because if you only look at the price, you might say gold fell, so demand must be gone. But if you look at who is selling, you may reach a completely different conclusion. Maybe this selling is not a sign of collapsing demand. Maybe it is a sign of pressure and necessity. And if selling is driven by necessity, then it is not always permanent. This is exactly where the idea of a reset begins. What does a reset actually mean? A reset does not mean everything has collapsed. A reset does not mean the long-term thesis has been proven wrong. A reset means the market is going through a shock that is forcing it into a temporary phase of structural, psychological, and price cleansing. First comes the rally, then comes excitement, then comes overconfidence. Then even the people who never understood the real story enter the market just because it is moving. Then a shock appears. Then forced selling begins. Then retail investors panic. Then they sell too. Then that selling pushes the price even lower. Then the noise gets louder. Then every expert starts selling their own explanation. Then a new reality begins to form on the chart. But then what? Then the real question becomes whether the core reason that made gold powerful in the first place is still alive or not. And in my view, that is where today's picture becomes interesting. Because yes, there is forced selling on one side, but strategic buying has not completely disappeared on the other side. For example, China's central bank continued increasing its gold reserves through March 2026 for the 17th straight month. That means the world's second largest economy, despite the recent weakness in price, has not stepped away from gold at a strategic level. That is a very important signal, because if the world had truly decided that gold no longer mattered, then this type of steady official buying would not still be happening. And alongside that, global gold demand remained historically strong in 2025, while central banks continued buying on a very elevated scale. So now pause and think about what that means. On one side, some official players are selling under pressure. On the other side, some official players are still accumulating. What does that tell us? It does not tell us that the gold story is over. It tells us that the world is not moving in one single direction. Some countries are trying to save liquidity today. Some countries are buying protection for tomorrow. Some need dollars. Some want distance from the dollar. Some are trying to stabilize their financial systems. Some are restructuring their reserve systems. And when all of those forces operate at the same time, the price of gold is no longer just a simple emotional vote. It becomes a reflection of global balance and imbalance. Now, if you want to understand this whole situation inside a larger framework, I think the best way is to break it into 3 stages. The first stage is forced liquidation. This is the stage we are probably still in, or at least still feeling the effects of. In this phase, the seller is not necessarily selling because they changed their mind. They are selling because they need to survive. They need to make payments. They need to defend a currency. They need to send a signal to the market that they still have room to defend their system. In that kind of phase, prices fall, but the nature of the decline matters a lot. This kind of decline is often not ideological. It is practical. It is not usually a rejection of gold. It is a response to a lack of cash. And that is why this kind of drop creates so much noise, because outside investors only see the price, not the reason. The second stage is stabilization. This is the stage where everything does not suddenly become good again, but things stop getting worse as quickly. If oil stops holding above $100, if weak currencies stop making fresh lows every day, if diplomatic possibilities reduce some of the stress, and if emergency dollar demand begins to soften, then the forced selling that was dominating the market can slowly begin to fade. And that is the delicate moment when the people who truly understand markets stop staring only at the chart and start reading the conditions behind it. The recent softness in oil that helped gold stabilize matters for exactly that reason. It does not guarantee that the crisis is over, but it does remind you that if the underlying pressure begins to ease, price behavior can begin to change with it. The third stage is strategic re-entry. This is the stage that most people recognize too late, because it rarely begins with drama. It usually begins quietly. First, the sellers become less aggressive. Then the price stops falling. Then there is no explosive rally, but the lows begin to hold. Then the institutions that care about long-term reserve protection, strategic diversification, and geopolitical independence begin to come back. Then a new base starts to form. And very often that is where the next major move begins. That is why I keep saying this. Not every drop is a bear market. Some drops are cleansing phases. Some drops shake out the hands that entered only because the market had momentum. And once those hands are gone, the market often begins rebuilding itself on a far more serious and structural foundation. Now, here is another very important question. If this really is a reset, then what is the foundation underneath it? What is the bigger reason I do not believe the long-term gold story is dead? The answer is very simple. The world is still built on debt. The world is still fractured geopolitically. The world is still wrestling with the question of whether reserves are truly safe. And the world is still living with the reality that if your asset depends on someone else's system, then it may not be fully sovereign after all. Gold matters in that gap. Gold is not important because it always goes up. Gold is important because in certain conditions it becomes a substitute for trust. It matters because it has no counterparty. It matters because it does not depend on another country's promise to remain valuable. It matters because the more complex the financial system becomes, the more unique a non-counterparty asset becomes. That is why if some central banks are selling it today under pressure, that does not necessarily mean they will not buy it back tomorrow. In fact, sometimes the biggest future buyer is the same player who was forced to sell during a crisis. And this is exactly the part that ordinary observers often miss. They see the central bank sold, the story is over. But sometimes the truth is the central bank sold because in that moment it had no other choice. Those are not the same thing. They are two completely different worlds. Now let us bring this back to the present moment and ask what we should actually be watching. In my view, if you really want to understand this market, it is not enough to watch the price of gold alone. You need to watch three things. The first thing is oil. Because as long as energy prices remain unstable, the dollar pressure on import-dependent economies can remain intense. And when dollar pressure remains intense, central bank decisions become more defensive. The second thing is currencies, especially the currencies that are already under visible pressure, because when a domestic currency is weakening day after day, a central bank's decisions stop being ideological and become emergency decisions. The third thing is official buying and selling signals. Who has gone quiet? Who has paused? Who is being forced to sell? And who is quietly accumulating despite weakness in price? Those are the signals that tell you whether the current decline is just pressure or the preparation for a new cycle. And now I want to give you the most important conclusion of this entire script. My view is that the weakness we are seeing in gold right now is not a verdict against gold itself. It is more likely a reflection of global pressure, liquidity needs, currency defense, and energy shocks. It does not necessarily mean the long-term foundation under gold has disappeared. It means the market is being forced through a hard phase, and very often those hard phases become the most important turning points later. Because when forced selling finally ends, the buyers who return are usually the ones who care more about structure than noise. They are the ones who understand that temporary pressure and long-term logic are not the same thing. They are the ones who do not just read the chart. They read the world behind the chart. And if you want to understand this market seriously, that is exactly what you have to do as well. Watch the chart, but do not only watch the chart. Watch the price, but also watch the character behind the price. Read the headline, but also understand the pressure behind the headline. Because many times the market is not telling you the same story on the surface that it is telling underneath. Sometimes the price is screaming, but the reason is quiet. And the investor who understands that quiet reason is the one who sees the real picture. So if you ask me in one sentence what I see in the gold market today, my answer would be this. I do not see an ending. I see pressure, I see necessity, I see a hard reset, and I also see that underneath this reset, the same deep structural reasons that made gold important in the first place are still alive. That is why, in the months ahead, the people who matter most will be the ones who can tell the difference between fear and reality. The ones who can separate a temporary liquidity crisis from long-term reserve logic. The ones who understand that not every sale is an opinion and not every drop is an ending. And perhaps that is exactly where the biggest opportunity is hiding. Because when the world is only looking at price, sometimes the real story is being written behind the price. This is Dalio Marco Mind. And if you want to understand markets through structure instead of noise, then remember this. The biggest moves often begin when most people can only see fear, while the real players are reading the cause behind it.